Inside the $65 billion Ponzi scheme that fooled investors for a decade. In late 2008, when Wall Street was teetering on the brink of collapse, one financial scandal began to unfold that would change the landscape of investing forever. Bernard Madoff, once a titan of finance, was arrested for orchestrating what became the largest Ponzi scheme in history. Madoff's empire crumbled, revealing a staggering $65 billion disappearance. A staggering figure that left thousands of investors devastated and questioning the very foundations of trust in the financial system. This was not just a scandal, it was a betrayal of monumental proportions. Bernard Lawrence Madoff was born on April 29, 1938, in Queens, New York. With a career that began in humble beginnings as a penny stock trader, Madoff climbed his way to the pinnacle of Wall Street. In 1960, he formed Bernard L. Madoff Investment Securities, LLC, which quickly garnered a reputation for success. His firm specialized in market making and proprietary trading, activities that allowed Madoff to generate substantial revenue. By the late 1990s, Madoff became famed for his seemingly brilliant investment strategy, split-strike conversion, a sophisticated method involving options that promised consistent double-digit returns. As a member of the NASDAQ and a former chairman, Madoff was seen as a pillar of the investment community. He was a respected figure, known not just for his wealth, but as someone who gave back through philanthropic efforts, contributing to charities and addressing the Jewish community. His warm demeanor and charm drew in a host of high-profile clients, including celebrities, hedge funds, and nonprofit organizations. This allure and the prestige of his name masked what was occurring behind the curtains. However, beneath the polished exterior of Madoff's empire, something much darker lurked. While clients celebrated their supposed investment acumen, believing they were receiving exorbitant returns, Madoff was quietly diverting their funds into an elaborate scheme that would eventually unravel in spectacular fashion. The underlying truth was that there were no actual profits. The returns paid to earlier investors were simply money pooled from new investors. Madoff had set the stage for a perfect storm, one that was set to devastate many. As the financial crisis struck in 2008, panic ensued in markets worldwide. Investors sought to pull their investments from whatever safe havens they believed they could rely on. In this chaotic environment, Madoff's house of cards began to falter. The withdrawals from his firm surged exponentially, creating a liquidity crisis that Madoff couldn't withstand. In December 2008, after confessing the truth to his sons, who reported him to authorities, Madoff was arrested. The facade was shattered, and it marked the beginning of one of the most significant financial fraud investigations in American history. Madoff's trajectory from a penny stock trader to a multi-billionaire involved a mix of brilliance, lucky timing, and a groundbreaking promise: unwavering returns. He marketed his firm on the premise that he could provide investors with a steady 10 to 12% return annually, irrespective of market fluctuations. For numerous investors starved for security in increasingly volatile times, this was an irresistible proposition. One of the key drivers of Madoff's success was the glowing reputation he cultivated within the finance community. He became a confidant and advisor to many key players in finance, which reinforced an environment of trust. His charm and deep-rooted connections allowed him to gather an expansive base of clients. Philanthropies, hedge funds, and wealthy families, like the likes of filmmaker Steven Spielberg and actor Kevin Bacon, placed their faith in Madoff's hands. At its peak, Madoff's firm managed approximately $65 billion in assets. Yet the reality behind the success was an intricate web designed for deception. Madoff skillfully utilized service-based firms, often controlled and operated without thorough oversight, to maintain the illusion of complexity in his operations. He employed a small team to manage the trading, enabling him to divert funds into personal accounts while displaying fabricated account statements to clients. Investors were not only drawn in by Madoff's consistent returns, but also by the aura of exclusivity. Access to Madoff's fund was coveted. It was marketed as an exclusive opportunity in which ordinary investors were often gatekept by wealthier peers. This exclusivity fostered a sense of urgency among potential clients to invest quickly, increasing the pool of funds that Madoff could manipulate. Yet, in the shadows of this rapidly rising success, there were whispers raising red flags. Financial analysts began questioning how Madoff consistently delivered returns that appeared too good to be true. A handful of journalists and financial experts pointed to discrepancies in his reported performance, surrounding Mr. Madoff with an air of intrigue and speculation. Nevertheless, an overwhelming majority turned a blind eye, bolstered by his status as a financier in good standing. Madoff's appeals to philanthropy and social goodwill further obscured the alarm signals that were beginning to surface among industry insiders. The culmination of this facade was a dedicated client base that nested within a false sense of security. Investors clung to Madoff's promises and succumbed to the fear of missing out on returns that made them feel elite. The larger businesses and institutions invested without adequate due diligence, instead relying on established trust and the allure of Madoff's reputation. But here is where it gets worse. Despite the growing concerns and emerging financial scrutiny, Madoff operated with impunity. He presented annual audited statements bearing signatures that investors assumed were valid, all created by a firm that lacked verifiable credentials. Madoff created the illusion of success by employing shell companies as middlemen, expertly avoiding detection by regulators like the Securities and Exchange Commission, SEC. Actually worked. When investigators began probing into the Madoff empire, they uncovered a shocking truth. There was no legitimate investment strategy backing the returns promised to clients. Instead, Madoff ran a classic Ponzi scheme, perpetuating a cycle where returns paid to older investors came from new investors' contributions. According to court documents, the structure of Madoff's operation involved manipulating paperwork, creating false financial statements, and employing various financial instruments that had no real-world applicability. With no legitimate trading activity occurring behind the scenes, Madoff could create the illusion of constant returns through fabricated trading records. For instance, detailed account statements indicated healthy gains, boasting figures that matched his promised returns, misleading clients with misleading confidence. The mechanics of how investors were misled relied heavily on forged documentation. Madoff employed a small, trusted team that managed day-to-day operations, comprising a handful of loyal employees who, either knowingly or unknowingly, facilitated this twisted scheme. Internal auditing controls were practically non-existent, as Madoff himself was in complete control of operations. To ensure that the investment flow remained consistent, Madoff returned funds selectively to investors. This approach kept most clients satisfied and disengaged, often reluctant to question his actions. Many clients were lulled into complacency, believing that their investments were too substantial to risk jeopardizing their status with the firm. Madoff's emphasis on confidentiality over transparency further entrenched this loyalty. Information about other investors and operations was carefully curated to manage perceptions. In 2008, as the global financial system began to destabilize, panic began to seep into his high-flying operation. Fund withdrawals increased, and investors clamored to redeem their principal amounts back in the wake of falling markets. Madoff was then faced with a daunting conundrum. He had to find new cash sources to pay off previous investors while maintaining his elaborate ruse. In doing so, Madoff's financial reports displayed staggering amounts of money under management, which were fictitious. By crunching the numbers, it is estimated that investors were promised returns as high as $15 billion in 2007 alone. However, the actual losses amounted to around $65 billion, encompassing both principal and fictitious gains. Once the scheme collapsed, it was discovered that only a fraction of those funds could be accounted for, as Madoff had diverted vast sums into personal use. Investigators soon learned about luxury spending, including lavish homes, yachts, and other illusory trappings of wealth. Madoff had ultimately bulldozed through a myriad of checks and balances within the financial system. He took advantage of regulatory breaches, weaker regulatory scrutiny, and the SEC's failure to act upon repeated warnings about Madoff's extraordinary returns allowed him to thrive. At the time of his arrest, the SEC had launched investigations on various firms and traders, but Madoff's multi-layered strategy kept him insulated from scrutiny. As the investigation progressed, the chilling reality of Madoff's deception captivated the nation. It wasn't just an isolated case of fraud. It was a gross betrayal that reflected failures within the broader financial regulatory systems that were supposed to protect investors and uphold the integrity of the markets. In the aftermath, the public and regulatory bodies began pondering the question that loomed over Madoff's empire. How did a man with so many visible warning signs escape scrutiny for so long? Marching towards the eventual unraveling of Madoff's empire was an inevitable reckoning. But at this moment, the extent of the devastation remained agonizingly cloaked behind the visage of continued financial prosperity, and the repercussions would echo well beyond boardroom discussions and investment seminars. Next video. For me, stories like Bernard Madoff remind us that trust, once broken, can take a lifetime to restore. Here at Corporate Crime Files, we bring you a new story every single day, exposing the schemes, the scandals, and the people behind them. Tomorrow, we're diving into the Wirecard scandal, the missing $2 billion. You won't want to miss it. I'll see you there. As the narrative of Bernard Madoff's grand scheme unfolded, many whispers began to emerge that sounded like warning bells. What seemed like a legitimate and sophisticated operation was intertwined with deception that would soon come crashing down. Psychology plus warning signs. Meet the man at the center of this colossal fraud, Bernard Madoff, a financier whose alluring charm and astounding success captivated investors and industry professionals across the world. He had the quintessential image of a successful Wall Street titan, polished demeanor, a resume boasting decades of experience, and an ostentatious philanthropic presence. But beneath this charismatic facade lay the attributes of an individual whose ambitions spiraled into narcissism. Madoff was not only a brilliant strategist, he was also a master manipulator. His ability to connect with people and gain their trust was key to his success. He frequently deployed charm alongside meticulously crafted narratives that painted his investment strategy as an unparalleled opportunity. However, the psychological undercurrent of this deception revealed a darker side. Madoff's alleged arrogance led him to believe he was untouchable, setting the stage for a financial disarray that would shock even the most seasoned professionals. As early as the 1990s, red flags began to emerge, yet they were dismissed amid Madoff's growing reputation. Some prominent hedge fund managers expressed skepticism, citing the improbability of Madoff's consistent annual returns of 10 to 12%, regardless of market fluctuations. Investigators later uncovered discussions among savvy investors who questioned his lack of transparency, particularly regarding his trading strategies and the absence of verifiable custodians for funds. Despite these concerns, many felt it would be unwise to challenge such a reputable figure, showcasing a pervasive trust in established norms of Wall Street. But herein lies a crucial element of Madoff's manipulation. His charm often obscured valid concerns, convincing a community of investors that their hesitancy was unfounded. The psychology of such a situation showcases the cognitive biases that can cloud rational judgment. Investors succumbed to the allure of Madoff's seeming infallibility, opting to overlook the signs that should have raised alarm. Reports began to swirl by 2008, even as Madoff's operation expanded, yet they struggled to gain traction. Whistleblower Harry Markopolos famously tried to sound the alarm on Madoff's practices in 2005. Markopolos, a former derivatives expert, presented data to the Securities and Exchange Commission, SEC, alleging Madoff's operations constituted a Ponzi scheme. Disregarding his comprehensive analysis, the SEC closed their investigation, unable to crack the veil of Madoff's charisma, deceptive candor, and the iron grip of his established reputation. The culmination of these warning signs emerged in 2008 as the world was barreling towards a financial crisis. As Lehman Brothers fell, Madoff's investors began facing redemption requests at an unprecedented rate. The storm was approaching and the waves of skepticism grew louder. For them, the trust that once seemed so solid was now crumbling under scrutiny. In December 2008, the tide turned dramatically. With billions vanishing into the shadows of his complicated network, Bernard Madoff was forced to confront the reality of his actions. On December 10, 2008, the FBI arrested him, marking the beginning of the end for Madoff and the monumental fraud he had orchestrated. Prosecutors allege that Madoff misappropriated approximately $65 billion from thousands of investors worldwide, a hologram of success that ultimately flickered and died. Madoff's initial confession delivered to his sons was as shocking as it was chaotic. He openly admitted that he had been running a Ponzi scheme, informing them that the profits promised to investors were built on a foundation of lies. The revelations cascaded swiftly. As the news broke, the financial community felt the repercussions. By the end of the week, news outlets broadcasted the collapse of what was once one of the most revered financial empires, shaking the foundation of trust in investment banking. The fallout continued in its intensity. Investigations launched by the SEC found that Madoff capitalized on unregulated investments to cover losses and repay earlier investors, a classic characteristic of a Ponzi scheme. Legal authorities swiftly initiated investigations. Vast financial records revealed the existence of fictitious statements and fabricated trading activity. The drama soon escalated as the narrative unfolded in courtrooms. On March 12, 2009, Madoff was charged with 11 felony counts, including securities fraud, wire fraud, and investment advisor fraud. Ultimately, his case culminated with a guilty plea in March 2009. In June of the same year, he was sentenced to 150 years in prison, which was a startlingly stark contrast to the life he previously enjoyed among the elite. The system that allowed Madoff to thrive for decades began to be scrutinized in earnest. The SEC, which had come under intense criticism for its failure to detect the scheme, faced accusations of institutional negligence. By 2010, a report from the SEC's Inspector General revealed that the agency's inability to act on the repeated warnings exposed systemic flaws within its regulatory infrastructure. Meanwhile, Trustee Irving Picard embarked on a groundbreaking recovery mission to reclaim as much of the misappropriated funds as possible. This led to a lingering legal battle that continues today. Investor losses reached an estimated $18 billion even after recovery efforts. But the law would exact its own toll on the Madoff legacy. The scandal became a symbol of unbridled greed, shaking the foundations of investor confidence across the globe. The aftermath was staggering. Livelihoods were altered irrevocably. Many of those affected were left homeless or financially impotent. A wave of societal anger surged toward Madoff and the institutions that had allowed him to flourish unchecked. The overarching theme was not just about financial integrity. It revolved around trust within the investment community, now challenged more than ever, and lessons. The Madoff scandal served as a dark reminder that the very structure of modern finance is vulnerable to manipulation. The consequences of Madoff's actions ripple into policies and regulations enacted by agencies straddled with a different reality in the post-Madoff world. Maureen O'Hara, a leading financial economist, pointed out that Madoff's operations revealed clear gaps that regulators must endure. Regulatory frameworks that should have functioned as gatekeepers failed stunningly, showcasing that trust without verification can lead to catastrophic results. This negligence motivated a reevaluation of investor protections. In 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted, launching significant regulatory changes, including greater scrutiny of investment advisors and hedge funds. Madoff's once envied life now serves as a grim parable to the financial industry. As of October 2023, the case remains a cornerstone for ongoing discussions about ethics and the urgent need for transparency in financial dealings. Could something like this happen again? In a world where trust is paramount yet easily corrupted, the importance of vigilance cannot be understated. For me, stories like this remind us that the balance of trust and responsibility is fragile within the economy. Here at Corporate Crime Files, we bring you a new story every single day, exposing the schemes, the scandals, and the people behind them. Tomorrow, we are diving into Wirecard, the missing $2 billion. You will not want to miss it. I'll see you there.